Hi, this is Morty Sill, broadcasting from my Mercedes. I just wanted to talk to you about risk. Now, there are a number of risks with foreign currency trading, and I think the best way to work through them is to start off with the trader. Now, the trader could have a health event, I suppose. I suspect they're extremely rare, but not all FXMoneyMap traders are spring chickens. And so some health event actually in front of the screen is a risk. And then working from there, you could have a failure of the mouse, the screen could fail, the computer can fail. Then we're looking at broadband connections. I actually have 3 broadband connections. I usually trade through the landline, but I do have mobile broadband as a backup, and if all else fails, I can take my laptop down to Starbucks and use their Wi-Fi. Then we have failures with the broker. He may not want to deal. His software may fail, and of course his business may fail, although FX broker failures are fairly uncommon. Next we have problems with the markets, and they're usually, in my experience, those are usually related to world events. What essentially we're trying to do is we use Fibonacci to try and model the foreign currency markets. Of course, they're not modelled at all by Fibonacci, although Fibonacci is very close. In fact, they are a chaotic adaptive system, and so what essentially you have millions and millions of random events, and then you get sudden self-organisation, and we hope to identify that self-organisation early and capitalise on it. Now, what we don't want is non-random events, if you like. So we want lots of small random events, but what we don't want is we don't want an earthquake, we don't want a 9/11, we don't want an outbreak of war. Now, I have personal experience with this trading. I remember trading at Trader House one Wednesday when I was short dollar Swiss. This was about 2 years or so after 9/11, and a commercial airline pilot got lost and strayed into the Pentagon exclusion zone. We think it was probably because of a GPS failure. Anyway, as you can imagine, all hell broke loose, and F-16s were scrambled, and this got onto Reuters, and the dollar dropped. It was precipitous. It fell off the edge of a cliff. Now, fortunately, I was short Swiss dollar Swiss, and so thank you very much. I did very well out of it. But I could have been long, and in which case it would have been disastrous, particularly if I was in size at all. So this is one of the reasons that shaped my style, is why I like to be in for a short period of time. Now, my recent posts have shown me being in 4 or 5 minutes. And I think when we looked at this, I audited this about 3 or 4 years ago and looked at the classic FXMoneyMap trade. Usually lasted about 45 minutes, something like that. My trades on average last about 5 minutes, and that much more suits my trading style, because I know that every second that goes past, something can happen that makes a big difference to the currency pair price that I'm trading. So I hope I've sort of explained some of the things about risk. The other thing I really need to talk about is stop. In other words, limiting downside risk. Now, the classic way to do this is to say, well, I have no idea what the currency markets are going to do, and essentially all I do is flip a coin. But I get an edge because I have a 20-point stop and a 30-point limit. So I always make 10 pips if I win. I always make 30 pips if I win. I always lose 20 pips if I lose. And over time, I make 10 pips. Okay, so that's one way of doing it. However, it's not very sophisticated if, for example, you have a large win-to-loss ratio. And certainly you get that with FXMoneyMap. There are a large number of wins and a small number of losses. And so you do not have to keep hanging out for these 30-point wins. And that's, of course, dictated by the 20-point stop. You have to exceed your stops. If you have a large stop, you can have an even larger limit. You don't have to do that if you have wins that exceed losses by a considerable amount. So that means, for example, you can have a downside risk of, say, 30 points. So you look at the red boxes that you're trading using as an entry level, and the boxes on the other side of the cluster, usually we look for about a 30-point downside risk. That you can take 10 or 15 points on a winning trade because you know you're going to do that a lot of times. So, for example, if you traded, say, 20 times and you won, say, 15 of those, then at 10 pips you'd have 150 pips. If you lost 5 of them with a 20-point stop, then you'd be ahead 10 pips. And that's the way I think we should look at our risk-reward ratios, is not in terms of our limits exceeding our stops, but we should look at our wins to loss ratio. And with mine, the quarter that's just gone, so July, August and September, that quarter, Q3, I lost 1 trade. And I think I traded about 30 times. So I can afford to run mental stops. I don't put actual stops in. I can afford to run mental stops of 30 pips and take 9, 16 pip profits and still have my edge. Now I see on the forum, the FXMoneyMap forum, people talking about stops and putting very tight stops in and then getting stopped out and wondering what the hell's going on, even though they positioned them when it became positive subsequently. Is that the problem with putting a stop in is if you're short and you put a 20 pip stop in, you're essentially saying to your broker, I want to buy at this level. And that's exactly what he'll do. He'll sell you. He will find that stop and he will fill you. It is very bad news to put stops in. You shouldn't herald to the market where you want to deal, because the market makers will try and find those levels, and certainly you should never tell them where your stops are. So you should have a mental stop. You should be very disciplined about getting out at that stop, but I would strongly recommend not heralding to the market, and particularly the broker, where you're happy to get out, how much you're happy to lose, because he will say, thank you very much, that's exactly what we'll do. We'll get you to lose at that point. So I would strongly recommend mental stops. It means having the psychological fortitude to get out when you see that stop. So what happens commonly in the vanilla trade is if it goes against you, the price moves to the red boxes on the other side of your trade. So if you're short, there'll be red boxes above the position you entered in, and that's where your mental stop will be. And when you see price hit that point, and hopefully that won't be too often, you have to get out. Be happy to take a small loss and go home. There's always another day. What you don't want to do is have big hits on your equity, because if you dig yourself a hole with your equity, it's very difficult to recover. Extraordinarily difficult to trade your way out of a big deficit. If you have a drawdown of 15 or 20%, you are in real trouble. You never ever want to be in that position. So it's almost like Zen. I want to write a book called The Zen of Forex currency trading. You need the mental fortitude to get out at a stop mentally, the mental stop when price reaches that level. Okay, so this is Morty Sill saying goodbye from my Mercedes.